You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. It is a dangerous world out there. Volatility is on the rise, and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit ORATS.com or email Matt Amberson at matt@orats.com. And now, it's time to learn how to implement options in your practice. It's time for the Advisor's Option.
All right, everybody. That music means it is time once again for the Advisor's Option, the program here on the old Options Insider Radio Network, where we break down all the latest developments in the world of options, do some education, answer your questions, break down the buzz, all the fun stuff that you, the busy financial advisor, don't have time to do because you're busy dealing with your clients. Don't worry, we got you covered here on the Advisor's Option. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting, at least we think so, Options Insider Radio Network. Remember, I know a lot of you are coming to this show, and maybe you're a little bit newer to the world of options. Of course, we have a lot of great educational content on the network you should be checking out as well, including Options Bootcamp and Options Playbook Radio. Those 2 programs are a great way to learn about options on your own time, on your own schedule. So when your clients come to you with questions that maybe are a little bit outside your wheelhouse, those shows will help steer you in the right direction. Of course, keep those questions and comments coming. We do love to hear from all of you out there. Let's see who we're hearing from on the program today. First, let's go out to the volatility mecca known as New Hampshire. We are joined once again by Mr. Matt Amberson, the founder over there at ORATS, a.k.a. Options Research and Technology Services. Mr. Matt, welcome back to the Advisor's Option, sir.
Thanks, Mark. I'm finding that more and more people are listening to the show. I'm getting feedback from my clients. One of them said, you guys talk too much at the beginning. Let's just get to it. You guys have so much good stuff. Why don't you just get to it right away? I'm like, okay, get off my case. Go. So we're getting right to it. We're listening. We're getting right to it, Mark.
People, everyone's a critic. What can I say? Everyone's a critic out there, Matt. And also joining us to help us get right to it is our guest today, Mr. Peter Montgomery, the partner over there at CARRICK Lane. Peter, welcome to the Advisors Option Program.
Mark, thanks so much for having me. Excited to be on.
And you know what, Peter, in spite of what Matt's client wants, we're going to take a minute here at the top of the show because you never have been on the network before, let alone the Advisors Option. Why don't you go ahead and give our audience a little bit of an overview of your background in the options and derivative space, as well as what it is you guys do over there at CARRICK Lane.
Great. No, sounds good. I guess my experience going back into volatility and options in particular goes back to kind of the early 2000s. And I was actually kind of a client of one of these service providers. I worked at a single family office who had a very large single stock position. And so we, started off doing covered calls and then, in-house, and then did it, hired somebody else because it took so much effort to do. And so then I went to business school and joined that same firm, which was acquired by Credit Suisse, and kind of continued on in that space, and have been kind of doing it ever since in different forms and capacities. And my partners here at CARRICK Lane, we all used to actually work together in the mid 2000s back at Credit Suisse, and kind of went our separate ways doing, building different businesses, and have come back together more recently to form CARRICK Lane, and really kind of focus more on what we're doing currently. So as far as CARRICK Lane is concerned, we are option specialists. We're volatility specialists. We work with high net worth families, advisors, family offices, et cetera, to work with them to design different types of strategies based on their objectives. We really take a consultative approach to what we're doing. I would bucket kind of our solutions, our offerings in kind of three. We have kind of our put writing suite, which is kind of really, really driven by folks who are looking for return enhancement, additional yield, however you want to frame it in your portfolio. We have kind of enhanced exit or diversification type strategies, which I would put in kind of the covered call space. And then lastly, kind of bespoke kind of protection or hedging solutions, which has definitely been a little bit more difficult in this environment, just, with skew being as steep as it's been, it's quite expensive to hedge out. So kind of quick and dirty what we do, to get to your clients, Matt. So let's get to it.
The clients are demanding, but you mentioned the magic word skew. So let's get to it. It is time for the P&L statement.
What the heck happened in the options markets since our last episode? Let's find out with the P&L statement.
All right, everybody, welcome to the P&L statement. Since the pandemic began, really, we started every show kind of diving into what the heck happened, what crazy things have happened in the world of options and volatility since our last show. Usually, it's a lot of things. So we decided let's just add a segment where we encapsulate all of that at the top of the show. Mr. Matt, we will start with you. We'll give Peter a break. Then we'll come back to him here. Obviously, Matt, a lot has been going on since the last time we chatted, a lot from a broad valuation perspective, from a volatility perspective, from, as Peter just mentioned, a skew perspective. I know you crunch all of that in your models over there at ORATS. What has been lighting up your tape since our last program, sir?
Yeah, we had a little bumpiness, but as we talked about on the last program, it felt like earnings to me was going to be something where, earnings were okay. They mattered more. But the market kind of just, it felt like it was going to float higher. And that's exactly what happened. It just, on these earnings, there's nothing really scary about them. So they were able to rally it. Peter mentioned the skew, the steepness of the put call slope. We measure that regularly. It has been coming down, as Andrew and I mentioned on Friday. We saw it coming down then. And now we're seeing it. One of the things that we offer is the weighted component. So I'm looking at the S&P 500 weighted components, and even in that realm, they've come down so much. They've come down like we measure it 4% down to 2%. So they've literally halved it since the last time we've talked. And the broader market, the ETF has come down as well. And then, I think earnings has been generally, well received. Now I'm kind of feeling the other way, Mark. Look at my numbers now. The S&P is a little bit up, but the vol just kind of popped today. And Contango came down, which that's not healthy for the market as it goes a little bit towards backwardation. And some of my other numbers I look at, the forward volatility relationships are starting to get a little skittish. So slope has caught a bid. So if I had to predict going into this next week or so, I'm gonna predict a little bit bumpier. Kind of called the rally. I think the rally is getting tired. I think we might see a little bit of correction, but this market overall still looks pretty strong, Mark.
Interesting. Busting out the old Oracle of New Hampshire hat. We'll get to all of that again in a little bit. Let's go out to Peter now. Peter, obviously, Matt touched on a lot. You touched on a lot even earlier. There are a lot of moving parts to this market right now. We have new all-time highs pretty much yet again. We had volatility skew that was pretty rich. Matt has mentioned it's kind of come in a little bit. It's still pretty frothy, still pretty beefy out there. And of course, we have volatility itself, which was very bit up, that has come in a little bit out there right now. So a lot of moving parts, a lot of things to analyze. What has been catching your eye? What's been lighting up your tape over there at Carrick Lane these days, sir?
Yeah, no, I think we're, similar to what Matt was saying, right? Skew has come down a little bit. Vol, obviously, with VIX has come down, the last couple of weeks. So it might feel a little light when kind of relative to the last 18 months, right? Since the COVID crash, even before that. But so it might feel a little bit light or a little bit less from a skew perspective than it's been, but historically it's still steep and vol is still, relatively high. So we're still, very, constructive on the space, the strategy, like the idea of selling puts in this market. There's some structural things that are, helping, option sellers in general, just the vol risk premium. And you have skew on the put side of things. You're getting paid a little bit more for puts. And we, like most, I think, volatility sellers are relatively short dated. And so you're kind of taking advantage of that time decay or that theta that's happening. I think as far as, we don't really take views on the market. We're pretty systematic in what we're doing. But I do, we do think from a skew perspective, as absolute volatility kind of comes down a little bit, which it probably will. We might see, a kind of a 14 handle VIX maybe today, if we haven't already, probably skew might be bid back up just as kind of the absolute level of hedging, the cost of hedging kind of goes down. That might get bid back up. So that's something that we're watching pretty closely as well.
So let's say in this environment, particularly let's say a few weeks ago, when skew was at its absolute apex out there, I'm sure you have a lot of clients coming to you in this environment. And this is a common use case for a lot of advisors out there. They want to use options to hedge. They think we're at all-time highs. They're a little bit spooked. They want to know how they can use options to hedge. And of course, an environment where skew is extremely rich, and even now where it's not quite as rich, but still pretty elevated out there, that obviously poses a challenge. So what is your approach over there at Carrick Lane for getting around that? If you're constructing your traditional put or put spread or collar, how are you guys going about that right now?
Yeah, no, and it's really kind of on a case-by-case basis and trying to understand what is really at the heart of the client and what their objectives are. And so we'll have conversations of, are you trying to, on the hedging side of things, are you trying to hedge a specific event or a certain period of time? Are you trying to hedge to zero, right? Or are you trying to hedge a 10% drawdown, a 20% drawdown? Are you okay? Do you really think the market's going to be down more than 50%? Is there kind of a dollar value, amount that you're willing to spend? So really asking a lot of questions of those, the advisors of the clients, trying to figure out what their objectives are, and then coming back and kind of constructing different things. I mean, obviously the kind of the classic is doing as a caller, right? Is selling a call to help finance that put. But with skew as steep as it's been, you're really capping a lot of your upside. So unless you really believe the market's is going to trade more range bound, that might not be attractive, especially for your entire equity portfolio, right? What's the point of owning equities if you're just going to cap at all the upside? So it is really trying to delve down into the weeds from what the client wants or what they're trying to achieve, because the options you can do a lot with them, right? You can, I think somebody said they're very malleable. Somebody said that on your show, a little while ago, and that's true. And so you need to understand kind of what the client objectives are, and then we can help kind of bring that to them. So, and then on the flip side of that, and where most of our action is, or most of our assets, or most of our clients is on the put writing side. And for all those same reasons, put writing is a very attractive kind of return enhancement or yield enhancement for in this low yield environment.
Interesting, and you're right. Yeah, a collar, we've often joked about it on the show as being the holy grail position for a lot of financial advisors out there. But you're right; those puts are so expensive. You pretty much have to sell an at the money call at this point to even come close to paying for all of that. So that obviously limits its utility for a lot of people out there. So it sounds like you've switched to a lot of the flip side, the put writing. Is that mostly in individual equities these days, or are folks coming in taking advantage of the skew in the S&P to perhaps pick some lower entry points? Where are you writing the puts these days, Peter?
Yeah, so we're focused really on the index, the S&P 500 index options. Obviously, great liquidity, lots of strikes, lots of expirations. So that's great. You get some favorable tax treatment as well. So and that's certainly where you kind of historically have seen that vol risk premium being quite strong. Not that it's not elsewhere, but we like that. We also like the fact that everybody follows the S&P, or most of our clients are, right? And so kind of intuitively, they know where different levels are, even if they're not, following the options market very, very closely. We're, kind of what we're attempting to do. We have a couple of different flavors of our put writing strategy, but it's all based on the same thing, same drivers. And so we're not writing at the money. We're writing out of the money options. The goal again is to add some incremental return. Many people are kind of pairing up their fixed income portfolio with our put writing suite, just to add, maybe hit the bogeys that they're trying to get to from a yield perspective, instead of going out in duration or down on yield quality. This is a way to kind of make their existing assets work a little bit harder for them. So we're trying to, be relatively conservative. This isn't the big risk driver of someone's portfolio. Just adding incremental return without kind of impacting the existing portfolio or the managers that the advisor has selected.
And people love it when we talk about structure on this show. Hopefully Matt's client does as well. But I'm curious for you. Obviously, you mentioned you focus on out of the money puts. That's a common use case. What about time frame? How far out are you going? Quarterlies, monthlies, farther out, weeklies? What is your typical? I know it's going to vary by client, but if you had to say in your ballpark, where are you typically lining up that short put liquidity in the S&P?
Yeah, I would say, it's 30 to 90 days. It's been really in the last 12 months, that's definitely skewed. I won't use that word, but it's kind of been more towards the 30-day. But we have that flexibility, and that's something that we're in selecting the options that we're putting into place. Is we're looking at the vol surface and the term structure and trying to ascertain or where we think we're getting paid the best. We do want to keep things short dated and earning that time decay, but we have some flexibility around that. We also are looking at we like to say kind of the known unknowns. Right. And so kind of be it a Fed meeting or, some sort of, big earnings or an election. Right. So there's things out on the calendar that we know there's something's going to happen, and make a judgment call, I guess, on, if we're getting paid to take on that risk, or maybe we just avoid that event, altogether. So we look to construct a diversified portfolio of options, so we don't put kind of everything on one line, and so you kind of get some strike to diversification, some calendar, kind of expiration diversification, and the ability to kind of be kind of quote unquote fully utilized or underutilized, based on the risk that's in the portfolio, based on kind of those events, where volatility is, if we like it or not. We've been pretty fully invested, for quite some time. I mean, the vol risk premium has been carrying quite well, and so we've been able to take advantage of that.
And Mr. Matt, I know you're not talking to me. You spend a lot of time out there constructing a lot of different strategies, including put rights. I'm sure it's a pretty popular strategy over there at ORATS these days as well. What is your ideal setup right now, where the skew is still kind of rich, but not quite as rich as it was, let's say, the last time you and I chatted, sir?
The funny thing about listening to Peter is a lot of the things that he's mentioned, we've tested, and that's the way that we see it as well. That caller could really, I think it's a great point. Why own equities if you're just going to collar that tightly? We've done things like, I always talk about owning these way out of the money long puts just for the ability to sleep at night, but you got to pay for those somehow. How to do that? You could do a short put and essentially have kind of a diagonal put spread there. You could even do a 1x2, which all test pretty well. Sell one, buy two farther out of the money for a credit. Those tests. I like the short puts, short dated out of the money. You don't get a whole lot, but you get enough, and you'd be surprised. You could just keep that coming in. You don't get called away very much, even in the COVID crash, even in 2008. Some other instances didn't get that pegged. So that's what's testing well on our side. Good sharps and sortinos. Those are the types of things I like to do to protect those long, way out of the money puts, Mark.
And you both touched on volatility. Big driver of that right now is earnings season. We're pretty much in the teeth of it, so let's get to that next.
Earnings announcements can move markets, but what is the options market telling us about upcoming earnings events? Let's find out with the Earnings Volatility Report.
All right, everyone, welcome to the Earnings Volatility Report. Remember, you guys can check all of this data for yourselves anytime, not just when you're listening to the show over there, theoptionsinsider.com. Click on the Options News and Articles tab. You can see all of Matt and his team's earnings move results, and earnings season reports. And we are right in the thick of it right now with the brand new season. We've already had some of the FANG names popping off, more to come. It is a hot and heavy week this week. We already just saw Facebook yesterday. Coming into today, we have Eli Lilly, JetBlue, Alphabet, formerly the G in the FANG, now perhaps a third A. We have Twitter and Robinhood today, Microsoft as well. Tomorrow, our friends across the street, Boeing, Coke, Mickey D's, Ford. Is it a meme? Is it not a meme? Certainly seems like it's behaving like one these days. Merck on Thursday, Apple and Amazon, two of the big A's out there. Starbucks and Gilead, just a whole bunch of names popping off. And Matt, when you and I were chatting on the show last month, you were kind of hinting at, you thought maybe this was the season where the worm was going to turn, where we were finally going to see this inflection point we've all been talking about for the last 18 or so months, when earnings vol was going to matter again. And you knocked it out of the park for the first week. 106%. So outperformance across the board. Week two, not so much. 56%, or 55%, I should say, out there. So catch us up. What's lighting up your tape? What are your thoughts now as we're in the middle of the early hot weeks of earnings seasons? Have you amended that outlook at all?
So as you and I like to talk about, we break the earnings season into 6 weeks. Generally, weeks 1 and 2 are not so hot for people that own the straddles. But then weeks 3, 4, 5 are usually a lot better. We felt we went through a year of COVID-related earnings that were very poor for earnings straddle holders. And we felt that it was time for earnings to matter again. What we saw was especially later in the last earnings season, we saw some big moves. We saw people starting to care more. So I made the call. Yeah, I think it's going to be a good earnings season. Week one was actually amazing, the highest week one we've ever had. Week two was the lowest one for options owners. So, but another funny related thing, Mark, is that before this earnings season, we went through. And of course, you were instrumental in getting us to put these reports together, do these calculations. We do these methods for identifying exactly what the straddle is applying for just the earnings move and what the residual straddle is. And we feel our earnings data is very strong and gives us an edge out there. So we decided to do some, as we do, a lot of back testing with it. So what we've really found is that, as we know, earnings tends to be overvalued, but you could really get burned selling straddle. So what's been coming up and testing well are these time calendars, these these term structure trades where we have a method. We actually make a complete surface of theoretical values based on our forecast of volatility, long-term volatility, earnings moves, slope, derivative, and then we find the best options in each cycle and see what's the most over and what's the most undervalued, turn that into a calendar, test that out. And, it's been testing very well. So even though, this earnings season hasn't been great for earnings holders, we do have a buy straddle test that we've done. The time spreads for this earnings are looking good. So today we have Juniper's reporting that came up on a test. We had Facebook. Facebook's moved a lot since the morning, but we came out with a signal. We basically get into the time spread the day before. They announce either in the night or before they open, and then you get out. So we've had some good tests going on there. So we're watching the earnings season very closely. Now it's a lot more fun because we're actually putting some signals out to our subscribers on, hey, here's our back test. Here are the stocks that have signaled for a long straddle, short straddle, but the time spreads are the ones that we're really looking at. So yeah, and like I said before, the market is just kind of floating on these earnings. It's seemingly like it's starting to turn now as the earnings cycle gets later. It seems like when you start to see a lot of trouble in the market is in the October cycles where the market is seasonally volatile and somewhat weak. That usually happens, after earnings or when the investing public starts to see the earnings moves. I think they're starting to see it now. That's why I think there's a possibility of a turn here, Mark. So that's what I'm seeing in earnings. A lot more fun to watch these days. And I think we're going to see some pretty good results in weeks 3, 4, or 5.
Yeah, it is encouraging to see some actual green on these reports. We've been doing these for years now, Matt, and certainly for the better part of the last couple. It's been naught but red just about every week, every announcement. Whatever the name is, they're pricing in, let's say, $5 worth of movement. They move 2.25, and they keep slashing it cycle after cycle, and they keep underperforming. It has been an impressive, some might say, mystifying trend that's been going on out there. So to see a little bit of green, any green out there right now from a vol outperformance perspective is interesting. And certainly if there's a week that's setting up for it with a lot of big names. Like this week, we have Alphabet, we had Facebook earlier this week, we have Microsoft, we have Mickey D's, we have Apple and Amazon and Boeing and Twitter and Robinhood. There's a lot of names poised to deliver some outperformance here. If you want to check out what those names are all pricing in, like I mentioned, let's pull one really quickly right now. Let's go to Microsoft, right? They're popping off on the 26th. So today, after the bell listeners, they're trading right around 309 as the time of this report. They're pricing in $8.31. In the past, they moved $7.58. So surprise, surprise, a name is actually pricing in a little bit more vol, a little bit more juice than they did in previous cycles, which is something we don't see much anymore and worthy of note when we do see it. Like, for example, Twitter is also today after the bell. They're at about 62.25. They're pricing in $6.32. In the past, they moved $6.57. That's more along the lines of what we usually see. In fact, that's light. Usually they take a lot more vol out of it than that out there. So interesting stuff. Peter, before we roll on out of this segment, obviously right now, a lot of people are fixated on earnings. It's one of the big drivers of the broad equity valuations we're seeing out there this week, and also what's going on from a vol perspective. So I'm curious for you, have you been paying attention to earnings season, and have you noticed this pattern that Matt and I have been talking about on the show now for many months about how almost no matter what the firms do, how much juice they price in, the result is usually a lot less when it comes to earnings vol perspective out there, Peter?
Yes. No, I mean, we don't kind of traffic too much in kind of the single stock names and making kind of any earnings calls. So we have noticed that. More of just observations and versus kind of ways we're implementing or putting it in to our strategies. But obviously, it's a big part of the day-to-day markets. So it is something that we're watching closely, especially some of the FANGs where we know it could have maybe an oversized impact on kind of the index levels and kind of vol levels. So certainly something that we're continuing to keep an eye on, and will continue to keep an eye on, but not anything that we're kind of constructing, kind of strategies right now.
Speaking of things people are keeping their eyes on, let's get to those right now. It is time to get the buzz.
Busy financial advisors don't have time to follow the latest developments from the options market, so we do it for you. It's time to get the buzz.
All right, everybody, welcome to The Buzz, the portion of the show where we break down some of the big stories in the world of options and derivatives that you may have missed since our last show, because, of course, you're busy dealing with your clients. And one of the biggest stories of the year, if not the biggest, at least from an options perspective, one that certainly people have been paying attention to month after month and asking us about month after month, is, of course, this notion of, hey, the options party, this thing has to fizzle out, right? This was kind of a one-off outlier. Everyone was stuck at home in 2020 during the pandemic. Those volume numbers we saw, the crazy record account numbers out of places like Robinhood and stuff, this had to come to an end. This year, people are getting back to work. We have the vaccines. So the narrative coming into 2021 was, you know what, the party's got to end sometime, folks. It was fun while it lasted, and certainly not fun for the broad society, but fun from an options perspective. And yet the narrative so far, month after month throughout the year of 2021 is, can the party continue? The answer is a resounding yes. We have the numbers for September. We're hot on the heels, about to get the numbers for October here as well. And could the party continue in September? The answer is a resounding yes. Numbers coming out of OCC for the last month. Total volume up another 22%, almost 21.8% compared to September of last year. Of course, last year, no slouch from an overall volume perspective. Overall volume for September, 816, almost 817 million contracts, up nearly 22%. And once again, just about every month this year has been the highest, whatever month it is in the history of the business, the highest March, the highest July, the highest February, and September also the highest volume September in the history of the options market. And even more stunning is that year-to-date ADV, so the average daily volume that is going up in the options market, that's 38.8 million contracts. That's up nearly 35% from this time last year. This time last year, people were saying this year is insane. We never, ever thought we could ever hit these volume numbers. And yet here we are doing them in 2020. But certainly, this could not continue. Not only is it continuing in 2021, it is actually exceeding it by nearly 35%. So if you had asked anyone, I think coming into this year, and we certainly did at the start of the year, if anyone expected this, I think the answer was a resounding no across the board. Yet here we are in September. The numbers don't lie. Peter, this is obviously good news for everyone in the space and who focuses on options, certainly for a lot of the advisors out there too, who maybe have been a little bit reticent to join the party. These numbers, they're going to start luring them to the dark side eventually. What are your thoughts on this ongoing question, this ongoing narrative of, could the volume party continue? And so far, the answer is a resounding yes. Are you as surprised by that, Peter, as I am?
I mean, we've seen the trends. I mean, certainly there's reasons to think, as you said, it might be over earlier this year. But no, I mean, I think people are getting more comfortable with them, the advisors, their clients, on the kind of the more retail side of things. And yet we love it, right? So, we're very happy with it. You're seeing more liquidity and like the SPX minis and, the SPX, the bigs are obviously always been pretty liquid, but more liquidity, more participation is a good thing. So we're very supportive.
And Mr. Matt, I know you're looking at these overall volume numbers as well. You're kind of like me. You've had the narrative beat into your skull now. So it should come as no surprise that September is the highest September in the history of the business. But still, what are your thoughts on this just amazing 35% year-to-date ADV up over an already options tsunami that was 2020, Matt?
Well, I saw a graph of the Fed's money supply overlaid with the options market, and it was eerily similar. There's just a lot of money rolling around out there. Options are becoming a lot more popular, not only with the small individual people that were home, but also with advisors, with institutions. We are getting queries from all over the place. So I think it's, one, just a lot of money sloshing around out there, and two, a lot more interest. And, as we know through the Cirilli study, once people start to trade it in their own accounts, they start to bring it to work and they're more comfortable trading it for their clients. So I think it's just something that's going to grow, but it's awful contingent, as many things are in the financial world with the Fed's easy money. So that's the way I look at it, Mark.
Well, when you're talking about things people want to trade in light of the Fed and their easy money, that leads directly into our next topic here. It's kind of the elephant in the room. You can't avoid it. It is taking up all the air and all the airwaves out there these days. And for us, we touched on it a little bit in the past, this asset class. I know it's been one you've dabbled with in the past. Matt, we obviously have a show every week here on the network talking about all things crypto, but it isn't an area we really dove into fully on this show because the availability of options on crypto for a lot of the US-based RIAs was very limited. The big venue out there is Deribit, and that's inaccessible for most of the US audience unless you're tunneling through the VPN and violating their terms of service and all these other things. So it really was an interesting space. We talked about it, but it wasn't something that was a viable option, pun intended, for a lot of our RIAs and asset managers in our audience. But that all changed this week, listeners. Yes, the moment many of you have been waiting for. Maybe others are still waiting for a different type of moment. But for a lot of you out there, you've been talking since the crypto space really captured a lot of mindshare for people back in, let's say, 2017, 2016. When we're going to get the ETF on this space. Well, we finally got one last week. Not quite the spot ETF that some people were hoping for, but instead, it was the PROSHARES Bitcoin Strategy ETF listed last week on the 19th of October. And instead of going to the spot markets, it goes to the CME futures markets. And if you listen to any of our shows that touch on that, Crypto Rundown, also our This Week in Futures options program that we do with CME here on the network, we talked about those futures in the past. They haven't really done a ton of volume, but they've been fairly steady for the last couple of years. Also, it's a very institutionally oriented product, very large contract, 5x multiplier out there, not at all for the retail audience, and also too big for a lot of the advisors probably out there as well. But still an interesting area, certainly a regulated marketplace, which made it easier for the SEC to approve a new ETF offering based on an already listed, already regulated product that they had an understanding of. And this thing launched under ticker symbol BITO last week, and it was kind of touch and go until the last minute. The SEC had until pretty much midnight on Tuesday to step in and stop the listing. And so people thought that might have happened, but it did not. We saw it listed last week under the ticker symbol BITO. And to say people went gangbusters for this thing is an understatement. This thing broke the records for the fastest ever ETF to attract more than 1 billion in AUM. It eclipsed the record set by GLD. that record has held since 2004, and BITO just blew the doors off of it over the course of the past week. Hasn't even had, I think as of today, it has its first full week of trading. It took in the second most assets of any US listed ETF this past week. again, a very strong start. It wasn't alone. They also followed it up with Valkyrie Funds launched their own Bitcoin strategy ETF on NASDAQ a couple of days later on the 22nd. So we now have a couple of Bitcoin ETFs out there oriented around the futures. And why is this interesting for advisors? For a bunch of reasons. First off, you previously had kind of the Grayscale Bitcoin Trust, and that was kind of it for a lot of the advisors out there. Now you have this ETF. You can put it in most of your clients' securities accounts. So that really jumps one of the first hassles. You don't have to open a futures account to trade this thing. And also, for our perspective, options. The OCC, they rushed options on this. They were out, I think, within 24 hours. I don't think I've ever seen that quick of a turnaround on a new listing. But we had options on this thing very quickly. So that means now, for effectively the first time, you can come in your securities account on behalf of your clients and trade options on a effectively Bitcoin denominated underlying. And I say effectively, we'll get into some of that in a little bit about what's going on over there from an underlying perspective and our thoughts. Let's go around the horn first. Peter, we'll start with you. I know you're not a crypto guy, but this is indeed the watershed moment a lot of the RIAs and asset managers have been waiting for. The crypto asset class is enormous. It's been exploding for years, and they've had very limited options, pun intended, to be able to trade it. Now they finally have some. What are your thoughts on this new offering and what it means for the advisors and asset managers out there, sir?
Yes, no, I mean, I think, democratizing, now, crypto is a good thing. More tools to invest and get it into clients' hands. I think, volume is going to be an interesting thing to see kind of how that looks, what the liquidity looks like, more specifically in the options. And so we're excited to keep watching it.
I think we're all excited to keep watching this one. Matt, I know you've had this on again, off again, on again love affair with the crypto space, but now we actually have the options in our hot little hands. We have our first ever ETF, more to come out there. What are your thoughts on this thing, Matt, and what it means for a lot of the RIAs and asset managers out there?
Well, I think from a signaling perspective, the Fed doesn't like competition. They make the money. They make a lot of money on making the money. They get a lot of control. So just the fact that they've allowed this to get this far, futures and now an ETF was a good signal for the price of Bitcoin itself. And the funny thing about BITO is it's almost too big for its own good. They're climbing up against their contract limits for the front month. CME has 2,000 contract limit, and they're at 1,900 or somewhere around there. So the CME might move that, but still, that is a pretty, with the size of that contract, BITO got huge so quickly that it's actually getting up against its liquidity limits at the CME, which is crazy. And the other thing about BITO, you might say, well, what about the roll down? Because now, we all know from listening to your show, Mark, about the problems of trying to replicate a spot contract with using futures. You got this roll down, and it's especially apparent in VIX, especially with UVXY, VXX that are constantly depreciating assets. Well, the BITO has they seem to have a lot more flexibility. They've moved out into the November contract, and it seems like they don't have the stringent rules that the ones based on the VIX spot do, and also just the contango of the Bitcoin is not nearly, it's maybe 10x lower than the VIX. So, this could be an interesting ETF, and the options are trading on it. There's, some pretty good trading going on it, and the skew kind of looks like we thought it would be, skewed to the upside, a lot of curvature, and much like Deribit and LedgerX that we were watching as well. So it's, this is a very interesting turn of events, and it's tracking the Bitcoin price pretty well. We've only had a week, but it looks like the Bitcoin price. So interesting ETF, Mark.
Yeah, there's a lot to unpack there, and I want to touch on all the things you just touched on because they're all very important. But I'm curious, Peter, we were just talking about skew earlier and how attractive that makes selling the puts in the downside in S&P. Like you mentioned, you're not an individual single name guy, but I have to imagine some clients are coming to you, perhaps with some interest in this space. Does the upside call skew, so kind of the inverse skew to the index that Matt was just talking about, that obviously makes things like covered calls a lot more attractive out there. Has that started to maybe draw your interest on some of these clients who are coming to you looking for maybe a little bit of income in crypto?
Yeah, I mean, interestingly, actually, we have not had anybody ask for that in particular. We have had people, ask just about in general what we think of it. I think it does pique our interest, right? It makes sense. You are getting paid, based on that skew. Again, I guess we would go back, to that client coming to us and, trying to understand kind of what their objectives are, right? Is it just to take advantage of the Bitcoin volatility, or do you rather be long it, right? And it's understanding kind of what that core objective is, and then looking and trying to implement something, that fits their needs or their wants.
Well, Matt touched on a number of things. Let me just hit on a few of them you may be interested in yourself out there in a little bit more detail, listeners. First off, people were surprised. I was surprised, quite frankly, at the depth of the surprise that people had when this thing was listed on the futures and not on the spot. It seemed a no-brainer to me, everything we've been hearing out of the SEC and the fact that what the CME is, its history, its track record, the depth of the liquidity there, it's a no-brainer that they would go that route first versus the spot. Let's just look at last week. Look at the prints we saw in Bitcoin spot just last week when someone tried to sell over 500 coins at once and ended up crushing it on one of the venues down to below 10,000. Those types of things are just one of the many reasons that is holding up the spot ETF that a lot of you are looking for. But some people are also concerned that maybe the futures are too small of a pool of liquidity. They're going to effectively have the tail wag the dog there when it comes to spot moving around the futures, and that could cause problems for the ETFs. A study here out of Bitwise Asset Management, they actually looked at where the price action begins and where the price discovery begins. They found that the Bitcoin futures at CME is where a lot of the price discovery actually begins. Price moves first on CME ahead of what you see on Coinbase and Kraken and some of the offshore venues. So according to them and their data, from a price discovery perspective, CME is actually the starting point for a lot of this, which makes sense. And also, I think should be reassuring for a lot of people out there who are worried about this ETF. But as Matt mentioned, there are other reasons to perhaps be concerned. If you saw what happened with USO last year with the great inversion in crude oil, as a result of that, USO became a very different product coming out of that. It migrated a lot of its liquidity out of the front month and across pretty much the broad spectrum of much longer term contracts out there. And so it became a very different beast. It didn't suffer from the roll yield as much, but also it didn't really track oil that well anymore either. We're starting to see hints of that in the ProShares ETF already. As Matt mentioned, the position limits are pretty stringent for CME on the Bitcoin futures. It's 4,000 contracts, and 3 days before expiration, that gets cut in half to 2,000. ProShares is already at that, if not exceeding that. So they've already had to spread a lot of their exposure out into the second month. And we've had Tim McCourt, who runs a lot of the crypto derivatives at CME on our network many times. We'll have to ask him about this particularly. He's a very busy guy these days. A lot of people are hitting him up about this exact topic. I would have to imagine CME might be willing to be flexible on that. This is driving a lot of paper to their product after all, but something to be cognizant of and cautious of if you're going to be diving into this thing as a longer term buy and hold. The thing you buy now may be very different in a few weeks or indeed a few months in terms of what it holds. And also in its prospectus, they are allowed to go out and buy things beyond the futures. So they could also load up on what they term equities with crypto exposure. What exactly are those equities? Who knows? So this thing's tracking may become a little bit more dicey, shall we say, as the popularity is victim of its own popularity, effectively. And the last point that Matt was talking about, it's been a hot thing ever since this thing listed. We were talking about it a lot last week. We had Russell Rhodes on our TWIFO show talking about it. People have been asking us about it. All week, people are crunching the numbers. They're used to seeing products like VXX and UVXY in the volatility space that get annihilated from roll yield, or even the previous incarnation of USO used to also suffer a lot of drag from that, effectively rolling down that contango curve, listeners. You're effectively buying expensive futures and selling them cheaper. That's going to have a bit of a headwind on your returns. So people have been wondering what exactly it's going to be in this BITO product. Again, Matt just kind of talked about it a little bit. Different people are crunching the numbers in different ways. Russell Rhodes, after we talked about it on our show last week on TWIFO, he crunched the numbers. He said, according to his analysis, he thought, again, BITO, not the same beast as a VXX, but that's what he compared it to. And he said if they followed a consistent rolling strategy, the roll yield, the headwind to the returns should be roughly 1/10 of what you see in a comparable VIX product like VXX. So good news for the Bitcoin bulls out there who want to buy and hold this thing. Maybe not great news for the folks who want to fade it all day. And then, of course, other folks crunching the numbers out here, looking at the current state of the futures. They estimate in the first roll coming up, it's going to be about a 1% cost. It happens this Friday. Of course, annualized, you're talking about 12%. That's on top of the 1% annual expense ratio. So just in this first week alone, if you annualize all that, as annualized is to about a 13% hit on top of this. So these are things to be aware of if you are going to dive into this product. I have a feeling, just put it out there, I have a feeling we're going to be talking about this again, because this is a big deal. This is really opening the door. Obviously, it's not an ideal product. It has a lot of issues, as we just pointed out. But for those of you out there, a lot of you are writing to us saying, hey, my clients are coming to me. They want to trade these things. What are my options, pun intended, if I want to do options on these? And unfortunately, they were very limited. Now you have more options. It's up to you whether you want to utilize them or not. But it is always nice at the end of the day to have more options. As we keep on rolling, I want to make sure we get some of you on the show here as well. So let's keep on rolling right on into our office hours.
It's time to answer your pressing questions about options. It's time to start our office hours. You can become a part of this segment by leaving a question on theoptionsinsider.com, emailing us at questions@theoptionsinsider.com, or via social media at twitter.com/options, facebook.com/theoptionsinsider, or stocktwits.com/optionsinsider.
All right, everybody, welcome to our office hours where we hang out our shingle. You folks ask us questions. You wait so patiently for your answers. You're very nice. And we get variations on this first question here all the time. This current incarnation comes from Valentine. He says, what would you say is the major issue preventing more advisors from recommending or using options with their clients right now? Again, an important question. Arguably the crux of this entire show, why it exists. Peter, what are your thoughts on this issue here for our listener, Valentine? What is keeping more advisors from diving into the options pool right now, sir?
Yeah, no, I mean, I think two things, I guess I would say, is one, it's just general familiarity, and maybe not understanding the complexity or lack thereof, depending on how you look at it, but also maybe a bad experience. And certainly in my career, I've seen it, with more on the covered call side of things, where people are trying to get it, enhancing their return on a single stock, and it's a concentrated position, and the stock gaps higher, due to any number of reasons, and the experience has been poor because that stock's upside was capped, and it's at no fault to the call writer or what have you. It's just that's some of the risk, to it. So I think it might be a bad experience, something like that, or just not being as familiar and maybe not having the time to explore it. I always go back to now I don't know how many years ago this was, but Warren Buffett's, quote about, option, derivatives being the weapons of mass destruction, as he went out and, sold massive amounts of puts on the S&P 500. So they can't be that massive weapons of mass destruction. So, I think it is just a matter of, not being familiar. It's still a little esoteric for many.
Yes, the Warren Buffett quotes. You're right. He's like, do as I say, not as I do, while he's blasting away on SPX puts. A conversation we've touched on many times on the network in the past. Mr. Matt, back to our question from Valentine. Kind of the crux of this entire program, the reason that we launched it. What would you say these days is keeping people out? Because quite frankly, Valentine, he's asking at a good time. These are the hottest times ever in the history of the options market. If not now, when, sir? What is keeping these guys and gals out?
I'd like to add, just the normal things. There's just a lot more stock traders out there. They're a little bit more complex. But you know what? I have a lot of advisor clients. The technology is not that great for options. A lot of the advisors will do a trade and try to spread it out to their clients, and they can do it with equities a lot easier. But the options are a lot more difficult. So, many of the same things that Peter said and that we've talked about before, but one of the things that I wanted to bring up is that the technology is not quite there. There are very few firms that do options well for advisors. So I think when that improves, that's going to help things, Mark.
Yeah, you're right. Tech is still a frequently cited pain point. When I did that panel at the OIC conference many years ago, that was kind of the birthplace and the genesis of this show, which we talked about exactly this. Why don't advisors use options? Tech was one of the big reasons cited then. And unfortunately, it's still an issue. You're right. The tools there, very different than what your even basic retail guy coming to firm XYZ. Let's say he's got 20 grand in his account. They roll out all the bells and whistles for that guy or gal. But the advisor coming in with a couple hundred SMAs, very different beast. It's a glorified spreadsheet. And so, yeah, it's still surprising how much of an issue, a pain point that is here on the show. Let's be nice. Let's squeeze in one more before we have to wrap up here. Let's go to this one here from Marcus. Let's go to Marcus. He wants to know, what is the ideal use case for advisors looking to adopt options in their practices? Well, this is an interesting question we've talked about many times. We've said on the show many times, collar is kind of the holy grail for advisors. But these days, as we touched on the top of the show, maybe not so much. So intriguing stuff. Peter, you spend your days doing this right now. If an advisor is coming to you looking to use options in his practice, what would you say is the ideal starting point for them?
I'm even going to go take a step back. Education, right, is understanding kind of what their goals are in implementing them, and then learning, how best to implement. And we're certainly out there, and you got the both of you, right? I think there's many more kind of practitioners that business is built around education, right, and getting the advisors comfortable and identifying kind of the risks and the objectives and getting comfortable with it. And that we suggest to many of our clients who are brand new, kind of start small, right? And I think we alluded to this earlier, right? You do it in your personal account and go around the track a couple times and get comfortable with it. Now that doesn't answer the question directly as like what's the best trade to do it, but I think it is about identifying and talking through what your objective is. Because options aren't magic, right? They're tools to kind of get to an outcome, and certainly there's lots of folks out there that want to help advisors, kind of create those tools and use those tools to their benefit. So I guess start slow, but be interested and curious, and that'll get you a long way.
Mr. Matt, same question for you, sir. What do you say is the ideal starting point, the ideal use case for advisors looking to adopt options right now, sir?
Well, me, I think that more people should have some protection on and then be able to pay for that protection in a responsible way and maybe even some timing there. So that's my big thing that, a lot of these people just have long only, and there's a lot more things that you could do with these puts, especially when the vol gets low. You could load up on some of those way out of the money puts, and then as the vol goes higher, you could sell some near term puts. You could do some 1x2s. You could sell some put spreads. So there's a lot that you could do to introduce some protection. Not everyone wants a sharp left to right upsloping line as their investment. What people want is some different looks to it, and it could have a mound. It doesn't have to be a covered call where you just lose everything. You could do a call spread. You could do a calendar. There's a lot of things that you could do. So I think it's just to change the look of the payoff diagram for investors is the main thing that options can do for them, Mark.
Well said. There are so many great starting points. Talked about income earlier. Obviously, the covered calls are great when people already have equities in their accounts, or if just very basic use case, you're very used to already working limit orders for your clients' accounts and selling and buying stock. If you just use options as a surrogate for it, selling put as a surrogate for a limit buy order, selling a covered call as a surrogate for a sell order, you're just getting a little bit of an income stream into your trading, things you're doing already anyway. So it's kind of an easier starting point. Then you can graduate to all of the various techniques and things we've broken down here on the show over the years. Unfortunately, listeners, that music means we come to the end of this episode here. But before we go, I want to thank our guest here, Mr. Peter from Carrick Lane. And Peter, before we go, we like to leave our audience wanting more. So if you have any hints or any teases of what you guys are working on or interesting things you have cooking up over there at Carrick Lane, or perhaps if people just want to learn more about what you folks are up to, where should they go? What should they do, Peter?
Yeah, great. Yes, I mean, we're kind of our goal is to, what we're focusing on mostly is making clients' existing assets work a little bit harder for them, and really kind of enhancing that return that they're seeking, additional yield. You can reach me. My email is peter@carricklane.com, and our website is carricklane.com. So please feel free to reach out to us, and happy to have any discussions that anybody would like.
That's Carrick, CARRICK, and Lane, LANE.com to learn more. Mr. Matt, what do you guys have cooking up over there in the land of ORATs that may intrigue our listeners, sir?
Well, like I said a little bit earlier in the show, Mark, we have put a big test together on earnings. So that's our fun new product. We also are going to have a release of our scanner and we have a whole new look to our website. We're going to have a whole new look to our web tool. So we're very excited about that. I did do my first trade in the BITO. Why you shame me into pulling it up?
I mocked you into doing it during the show.
Yeah. So, I'm.
Can you share with us what it was? I got a feeling you're selling some wings out there. That's what I'm thinking.
Actually, no. I own Bitcoin, and I want to do some callers on it. So I think these callers are pretty juicy.
Yes.
As Peter says, maybe the equities aren't. But these do look a little bit juicy. So some puts and calls. So anyway, you've shamed me into it. Well, come on over to orats.com. Very exciting new web tool is going to blow the doors, Mark. Can't wait to show it to you.
Check it out. Orats.com, ORATS.com is the place to go. Of course, give them a follow on the old Twitter @OptionRats. All one word, a very memorable handle out there. And you're right, collar is a little bit more attractive out there in a product like Bitcoin, where there's a bid to the upside and the puts are nice and cheap. So a little bit of a different beast than the equity indices right now. And of course, you guys know where to go to learn more about everything OCC has up its sleeve from its OIC educational arm. Optionseducation.org is the place to go to learn more, especially for all of you advisors out there. And on behalf of everybody over there at OCC and Mr. Matt and Peter and indeed myself, I thank all of you out there for downloading, streaming, and subscribing, and of course for joining us live in our live stream there. And of course, we have much more content in store for you folks throughout the week. And then of course, we'll be back again next month, another episode of The Advisor's Option. We'll see you then.
Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit ORATS.com or email Matt Amberson at matt@orats.com. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.